So we have a market that is doing quite well this week, bouncing back after all the worries. You see a name like a high flyer and momentum stocks really have some momentum, such as Tesla. What are your thoughts on what we're seeing?
It really feels like, almost 20 years ago to the day, the Y2K epic run up. I remember back then, I think Cisco was multiplied by 4 in 4 months. It actually nicely overlay a chart of Apple last year on top of Cisco. And you see the same kind of moves. I mean, today is perhaps the best example of this kind of almost irrational exuberance.
So too much? Is it too much euphoria? Is it too much unsustained without fundamentals? FOMO, getting in the market, I'm running and chasing. Are you worried?
Yeah, I mean, fundamentals, let's talk about them. I mean, earnings have been okay, but not great, if anything. I mean, earnings are basically flat. We had 4 quarters of earnings decline. We don't really have much of a rebound. Even the tech sector, that's doing really well price-wise.
Yes.
I mean, Facebook was kind of disappointing. Google was not all that great.
No.
So this is really getting very stretched compared to fundamentals that are not doing so good.
I mean, some people are saying that it's similar to the boom and bust of 2000, but not really. I mean, what would you say is not similar?
Right. Well, let me start with the similarities, maybe. I mean, I think that the biggest and perhaps the most important one is this massive central bank liquidity injections. I mean, in the fourth quarter of 1999, you had the Y2K fears, Fed's balance sheet expanded by 20%, and we're seeing the same thing with coordinated central bank easing. I think it's the only time we see both QE in the US, in Japan, in Europe, and now in China. So I think that is what really got the stock market going up. To me, the biggest difference, however, is the level of rates. Obviously, in 2000, you were at Fed funds rate above 5%. Today, we have room for like 3 more rate cuts stop.
All right, so you're saying that the Fed still has some bullets in the gun to sort of save the day a little bit. I mean, they certainly saved the year last year, because if you remember prior to last year's action, when they were in that hike mode,
right,
people started to freak out.
Right, and that is another strong similarity with 2000. And remember, 1998, we had East Asian crisis, LTCM, 3 emergency rate cuts, and that got the market going. Almost the same story for the core of 2018. The big difference, however, is where you start from. I mean, there's a big difference if you start at like 5 or 6%, where you have room for like 20 cuts, where if you're at 1.5, where obviously, we have 10 years of data in Europe to show that it doesn't work when you go below 0.
Are we more likely than not to see some more rate cuts this year?
A lot of it, I think, depends on the coronavirus situation. That could provide an excuse for more cuts. That's certainly what the market's expecting. I mean, we're making new lows on the 30-year. And I think that's partly what's driving the action in the tech and growth names. I mean, the more the yield curve inverts, the better it is for a company that has negative cash flow in the present and positive cash flow in the future, just because of the math of discounting. So the two phenomena are linked.
So do you think that growth continues to do well because of this phenomenon?
It's not so much about the growth, which may or may not be there, but it's about the discount rate at which you discount that growth that makes the value of future cash flow higher.
But tech stocks have been hot. Do you think tech continues to be hot, or are you more likely to see tech keep running, or more likely to see us move into a recession?
In general, what I would have expected up until last week, and I think what we're seeing in the market, was a rotation away from the momentum name, away from the growth tech names that have run up so much. And that was happening in November, December. And then we had this huge coronavirus scare, which paradoxically had the effect of reinflating the tech bubble.